When Ray Dalio liquidated billions in traditional stocks just months before the 2008 crash, he wasn't moving into bonds or treasury bills. When the Rothschild family weathered the Napoleonic Wars while European banks collapsed around them, they weren't hoarding gold coins. And when today's tech billionaires quietly diversify away from their own companies at market peaks, they're not buying cryptocurrency or precious metals like everyone expects. They're buying something completely different. 3 asset classes so unusual that most financial advisors have never heard of them, yet they've protected generational wealth through every major collapse in modern history. The 2008 financial crisis wiped out $2.4 trillion in global wealth. The dot-com crash destroyed $5 trillion. The 1929 stock market collapse erased 89% of market value over 3 years. But during each of these catastrophes, a small group of ultra-wealthy families not only preserved their fortunes, but actually increased them. They weren't lucky, they weren't insider trading, they were positioned in assets that operate by completely different rules than everything else you've been told to buy. Here's what nobody tells you about market crashes. They don't destroy wealth, they transfer it. From the unprepared to the prepared, from those holding the wrong assets to those holding the right ones. And the ultra-rich have spent centuries perfecting exactly which assets survive when everything else burns. These aren't your typical alternative investments. We're not talking about real estate investment trusts or commodity futures that still rise and fall with market sentiment. These are asset classes with mathematical properties that make them nearly immune to the forces that destroy traditional portfolios. The first strange asset class represents over $1.3 trillion in ultra-wealthy portfolios, yet 99% of retail investors have never owned a single dollar of it. The second generates double-digit returns even when interest rates collapse and bond markets implode. The third has outperformed the S&P 500 by 131% over the past 26 years, while maintaining near zero correlation to stock market movements. But here's what makes this information so valuable right now. Every indicator suggests we're approaching another major market correction. The Buffett indicator sits at 185% versus his danger threshold of 120%. Corporate insider selling has reached levels not seen since 2007. And the ultra-rich are quietly repositioning their portfolios using these exact 3 asset classes. Warren Buffett is sitting on $325 billion in cash, the largest capital position in market history. But that cash isn't staying in money market funds. Jeff Bezos has sold over $13 billion in Amazon stock through 2024, but he's not moving to treasury bonds. Mark Zuckerberg has dumped billions in Meta shares at all-time highs, but he's not buying real estate. They're following a playbook that's been refined through centuries of market cycles, positioning in assets that not only survive crashes, but profit from them. The first asset class is so essential to modern civilization that governments cannot allow it to fail, yet it generates returns that make private equity look conservative. We're talking about infrastructure investments, but not the kind you're thinking of. Not roads and bridges funded by municipal bonds that go bankrupt when tax revenues collapse. We're talking about private infrastructure assets that control the flow of data, energy, and essential services that society cannot function without. When the 2008 crisis hit, and real estate investment trusts lost 60% of their value, private infrastructure assets delivered positive returns. When the dot-com crash destroyed technology stocks, infrastructure investments continued paying steady dividends. When COVID-19 shut down entire economies, infrastructure assets became more valuable because digital dependency exploded overnight. The ultra-rich understand something that traditional investors miss. Infrastructure doesn't just survive economic downturns. It becomes more valuable during chaos because it controls what everyone needs most when everything else stops working. Data centers represent the perfect example of this strategy in action. Artificial intelligence and cloud computing have created insatiable demand for digital infrastructure. In 2020, private investors allocated $11 billion to data center infrastructure. By 2024, that number reached $50 billion, a 355% increase in 4 years. But here's the key difference between infrastructure investments and traditional real estate. Infrastructure assets typically operate under 20-year contracts with built-in inflation adjustments and government backing. When inflation destroys the purchasing power of bonds and crashes the value of growth stocks, infrastructure contracts automatically increase payments to match rising prices. Electric vehicle charging networks, battery storage facilities, 5G telecommunications infrastructure, hydrogen distribution systems, these aren't speculative technology plays. They're essential services with guaranteed revenue streams, backed by long-term contracts and regulatory frameworks that protect investors from market volatility. The ultra-rich aren't betting on these technologies. They're positioning to collect toll payments from everyone who uses them, but infrastructure requires massive capital commitments and decades-long investment horizons that most people cannot access. The minimum investment for private infrastructure funds typically starts at $1 million with 10-year lockup periods. This is intentional. The barriers to entry keep retail money out, which prevents the emotional buying and selling that creates volatility in public markets. When everyone can buy and sell an asset instantly, prices fluctuate based on fear and greed. When only sophisticated long-term investors can participate, prices reflect actual cash flows and fundamental value. The second asset class exploits a mathematical advantage that becomes more powerful as traditional investments become more dangerous. While bonds lose value when interest rates rise and stocks crash when earnings disappoint, this asset class generates higher returns in both scenarios. We're talking about private credit, specifically direct lending to middle market companies that cannot access traditional bank financing or public bond markets. Here's why this matters right now. Traditional banks have pulled back from business lending due to regulatory constraints and risk management concerns. This creates massive demand for alternative financing sources. Companies still need capital to operate, expand, and refinance existing debt, but they have fewer options than ever before. Private credit funds step in to fill this gap, but they dictate terms that heavily favor the lender. Direct lending posted annualized returns of 10.5% in the fourth quarter of 2024, beating high-yield bonds and leveraged loans, even while the Federal Reserve was cutting interest rates. The secret lies in the floating rate structure. Unlike bonds that pay fixed interest rates, private credit investments adjust their payments based on prevailing interest rates. When rates rise, the income from these investments rises automatically. When rates fall, the underlying companies become more profitable, reducing default risk and increasing the value of the loans. During the 7 periods of rising interest rates since 2008, direct lending averaged returns of 11.6%, 2 percentage points above its long-term average. This isn't correlation. This is mathematical certainty built into the contract structure. The ultra-rich aren't guessing about future interest rate movements. They're positioning in assets that profit regardless of which direction rates move. But private credit offers something even more valuable than high returns. It provides senior secured positions in the capital structure of borrowing companies. When a business faces financial difficulty, debt holders get paid before equity holders. When a company goes bankrupt, secured debt holders have first claim on all assets, including real estate, equipment, inventory, and intellectual property. This structural protection is why private credit has historically maintained much lower default rates than publicly traded high-yield bonds, even during economic downturns. The third asset class sounds completely insane until you see the numbers. While your stock portfolio loses half its value in the next crash, this asset class has delivered consistent positive returns through every major market collapse of the past century. We're talking about fine art and luxury collectibles, but not the way most people think about them. When the British Railway Pension Fund faced inflation rates of 17% in the 1970s, they made a decision that seemed crazy at the time. They allocated 3% of their holdings, about £40 million, into 2,400 art objects across multiple categories. While traditional investments were being destroyed by inflation, their art portfolio achieved annual compound returns of 13.1%. The stock market averaged 10% during the same period. The pension fund didn't just beat inflation, they crushed it using paintings and sculptures. Contemporary art has outperformed the S&P 500 by 131% over the past 26 years, while maintaining near zero correlation to stock market movements. Blue-chip artists like Picasso, Warhol, and Basquiat have delivered annualized returns of 8% to 12% over the past 2 decades. But here's what makes art so powerful as a crash protection asset. It operates in a completely different economic ecosystem than financial markets. When stock markets crash, wealthy collectors don't suddenly decide their Monet paintings are worthless. When bond markets collapse, museum-quality sculptures don't lose their cultural significance. When currencies devalue, masterpiece paintings actually become more valuable because they represent stores of value that transcend any single monetary system. The ultra-rich understand that art isn't just decoration, it's a hedge against the failure of financial systems themselves. The global art market reached $65.1 billion in 2024, but that number barely captures the real scope of this asset class. Deloitte estimates that art and collectibles represent a $2.174 trillion asset class among ultra-high net worth individuals. That's roughly half the size of the entire venture capital and private equity markets combined. By 2026, they project this figure will reach nearly $3 trillion as more wealthy investors discover what old money families have known for centuries. But art investing for crash protection isn't about buying random paintings and hoping they appreciate. The ultra-rich focus on specific categories with proven track records during economic chaos. Museum-quality pieces from established artists with auction history spanning decades. Works that major institutions compete to acquire. Pieces that represent cultural milestones or artistic movements that define entire eras. Designer handbags from brands like Hermes and Chanel have been making headlines as recession-proof investments. The handbag market appreciated 15% over the past year and is projected to reach £80 billion by 2026. But this isn't about fashion trends. This is about manufactured scarcity and brand control that creates artificial supply constraints. Hermes deliberately limits production of their most desirable bags, creating waiting lists that stretch for years. When economic uncertainty increases, demand for these scarce luxury goods actually rises because they represent portable wealth that transcends borders and currencies. Vintage watches, rare wines, classic automobiles, even collectible sneakers are generating returns that make traditional investments look pathetic. The Knight Frank Luxury Investment Index shows luxury goods have increased in value by 73% over the past decade. During the same period, the S&P 500 gained about 180%, but luxury goods maintained their value during every market correction, while stocks experienced multiple crashes and recoveries. Infrastructure, private credit, and luxury collectibles. Three asset classes that have protected generational wealth through every financial catastrophe of the past century. While retail investors chase the latest trends and financial advisors recommend the same failing strategies, the ultra-rich continue following a playbook refined through centuries of market cycles. The next crash is coming, and when it arrives, you'll either be positioned with the assets that profit from chaos or holding the ones that get destroyed by it.